Last week, when Gautam Adani pulled a rabbit out of his hat in the middle of the mother of all crisis that had seen him lose over $100 billion of market value within just a month, jaws dropped. First, nobody, and I mean nobody, had a clue. Even if they had some inkling, people were looking elsewhere. Till there was the formal announcement.
Rajiv Jain and GQG Partners, the man of the moment and the firm of the moment as far as the stock markets and India Inc. are concerned.
The deal which has made everyone happy. His 15,000 crore investment in Adani Group of stocks certainly lifted the spirit of Indian markets.
Adani Group promoter sells stakes in 4 companies to GQG Partners for 15,446 crore rupees.
The US-based and Australia-listed GQG has purchased shares in nearly about 4 Adani companies, including the group's flagship firm Adani Enterprises, through block deals.
But at the same time, everybody just had one set of questions. What on earth is GQG Partners, and who is its boss, Rajiv Jain, who is making this daring call to put nearly $2 billion across 4 Adani-listed companies after a sell-off that at one point erased nearly 2/3 of the group's market value.
This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My extra special guest this week is Rajiv Jain. He is the chairman and chief investment officer of GQG Partners, a firm with over $24 billion in assets under management. Rajiv was the 2012 Morningstar International Manager of the Year. He runs a number of different funds, the Goldman Sachs GQG Partners International Opportunities Fund, the Partners Emerging Market Equity Fund, and the Partners U.S. Select Equity Fund. Last year, his global fund was positive, while the benchmark was down 9%. Over the past 20 years, we've seen outperformance in all of the areas Rajiv works in, between 300 and 400 basis points.
That was a clip from 2019. Since then, Rajiv Jain has built GQG Partners into a $92 billion powerhouse. Few, if any, startup funds in recent memory have raised so much money in so little time, according to Morningstar Direct. But why then have we not heard about him again? Because he's not on Twitter. He rarely appears on TV interviews. He buys big tobacco stocks like ITC, big oil like Petrobras, Exxon, Total Energies, Reliance Industries, even when ESG activism is at its peak, legacy banks like HDFC, when fintechs are changing the way we deposit, transfer, transact, or spend our monies, confectioners like Lotte in South Korea, along with software firms like Infosys or growth stocks like AI companies, Nvidia, and not Uber, Facebook, or any other upstart that's into driverless cars or dog walking.
Most of the tech companies, when they list, the ownership of the founders or promoters, whatever they call them, is tend to be low. Why? Because there's not enough cash generation. If you look at the Zomatos and Nykas of this world, maybe some of them might turn out great businesses, but you have no idea what they're going to be in the next 12 months, let alone next 5 years.
Right. That's Rajiv Jain for you. Such clarity of thought worked for him before when he was the chief investment officer at Vontobel Asset Management, and now for the last 7 years at GQG, a Florida-based, Australia-listed investments fund group. But in this special podcast, we got him to talk exclusively to us from Australia, where he's currently working out this week for a no-holds-barred conversation with me, your host, Arijit Barman, on what arguably will be his most daring bet so far. We also talk about his Adani investment thesis, the group's business and balance sheet, promoter pledges to political affiliations, its crisis management strategy, and much, much more. It's Tuesday, 7th of March. You're listening to Rajiv Jain's Adani Adventures on the Morning Brief, and let's get down to business. I wanted to understand from you that why did you buy from the Adani Family Trust and not from the others?
Yeah, that's frankly not our decision. That was their decision. So we didn't pick and choose. From a structuring perspective, we thought it's better to sort of buy directly from the promoter family rather than sort of, in other words, secondary offering rather than primary offering. And a whole host of logistical reasons also because of timing, because in a lot of these things, timing matters. But the more important decision was the secondary versus primary. Who they sell was not my call. I mean, their call.
No, who they sell to is
No. Where they sell from was their call.
Right.
We didn't decide which trust or which holding, so we had no say in that.
Right. No, because there were other institutional shareholders also in the companies. So, for example, there have been murmurs that people like LIC and etc. would have loved to sell. So the first raising of the eyebrow happened when people said, oh, it is actually a secondary that the promoters are doing and not any other institutional shareholder of the company is doing.
Yeah, look, I mean, we were shopping around for 5 different places. Once you are shopping around, the deal is off, in my opinion, because the word would leak, right? So speed matters in these things.
Right.
And the stock, the way it was moving, we kind of knew that this won't last forever. The faster a stock declines, the sooner the decline would end, right?
Correct.
So you can't say, oh, we're going to look at it and let's come back in 6 months. Well, the deal is off because the stock won't as attractively valued. So it made sense to have a discussion was really from that rather than trying to go shopping for a block with somebody else. Frankly, we would have never done that because that would have made no sense.
You've had a long career, but has there been any situation in the past where you've picked up shares from the open market from the controlling shareholder of a company?
Yeah, look, I mean, I'm sure there have been some cases. I can't think immediately, but it's happened more than a few times where we've sort of been aggressive in a decline. I mean, to give you examples, I remember 2004 elections, there was a little bit of upset and the stocks declined, the whole market declined 25% plus. And I was actually at that point, ironically, in Australia, of all the places. I remember I was in Perth and, meeting Western Australia newspapers, and I'd come out of the meeting and said, hey, can I buy something? He said, everything is limited down. You can't buy anything. 1996, I remember there was an crisis in ITC because of the tax situation. Early 1996. And we ended up owning ITC for almost 20 plus years. So entry was attractive. And then, so crisis usually creates opportunities. And to be clear, I've gone some crisis dead wrong. For example, I was very nervous after this demonetization stuff. And I mean, boy, was I wrong in terms of what happened after that.
Now, let me add another layer to my previous question. Have you in the past, in your long career, picked up shares from the open market from a controlling shareholder who is under significant regulatory and legal scrutiny?
Yeah. I mean, see, it's hard to know who's selling at that point. Right? If you're buying an open market, you just don't know who's selling. So it's just difficult to say. But for example, in 2019, we bought Infosys when there was a whistleblower case. If you remember, that is not that long ago.
Right.
In fact, we bought Petrobras quite a bit aggressively in the last 2 years. There were a lot of issues. And in fact, I think we are the second largest shareholder after the government in Petrobras now. Right?
Wow. Okay.
So yes, we bought stuff. I mean, it's not the first time.
But, I was reading somewhere that you shared your thoughts, your investment rationale with your investors. I mean, par for the course. Can you share for us some of those 2 or 3 salient bullet points that explained your investment rationale?
We have significant, I believe, over $5 billion invested in various utility type businesses globally. And those are unique animals because those are regulated businesses. They tend to have a very long tail. And if they grow, they will have negative free cash flow. I think part of the issue here is that a lot of folks, frankly, don't fully understand how it goes in the utility side. As people talk about negative free cash utilities, my opinion is, okay, you don't fully understand how this works in utilities. So that's the first part of it. So second is debt. It's interesting, debt to EBITDA for most on an average, I'm talking about, is around 3 times. Green is a little bit higher and some a little bit lower. On an average, the US utilities have debt to EBITDA of around 6.5 times. 2x. If you're a cyclical business, you should not be levered.
Right.
In fact, in regular business, require you to be levered. There's nothing like a debt-free utility, a regulated utility, right? Think from an India context. There's so much need for infrastructure. Sky is the limit, right? You need somebody who can execute on it. Who owned Mumbai Airport before? Who owned the Mumbai T&D, Transmission Distribution Company? They were somebody else, private sector owned it, right? They couldn't run it.
Yeah.
And Adani's running fine. So I think when people forget, Adani Ports, did he get a full running port, full railway line, etc., or was it a patch in the middle of Kutch Desert? So I think in India, if you to get these 20-25-year visible growth is very powerful. Question is, again, what you're paying for that and so on and so forth. That's a different debate.
So your main thesis is the India investment, the macro story, the infrastructure story. And you would say that even for utilities like Adani Green and Adani Transmission, etc., the debt levels are pretty normal and actually less than many of their global peers. So nothing to be paranoid of.
So I have to qualify everything because you don't want to make a forecast 5 years, there's no problem because there's a debt refinancing issue in 18-24 months, right? So at that point, the markets should be reasonably open, or they could issue debt from an operating company perspective too, by the way. So there are ways around. In fact, we talked to a bunch of bankers who lend to them now, and they said, yeah, we love to lend now. We did a lot of due diligence of the folks who have dealt with before or now. In fact, some of the former partners or employees to get a sense of what's the culture of the place. And look, we feel very comfortable how the group has done them, and behaved. But you don't live in a vacuum, so things always move around. So while we take a 5+ year review, you still have to look at what's happening here and now.
Have any of your investors got back to you? These are GQG investors, got back to you with any concerns?
I mean, to be clear, people are concerned. I mean, if there was no controversy, we wouldn't be discussing this. I think controversy is part and parcel of that. We have talked to a lot of investors. We continue to talk to a lot of investors. But that's no different than, by the way, I talk about controversial trade. Cutting back technology in the developed markets 2 years ago was a heck of a lot more controversial than this.
Right.
Buying energy in 2020, late second half 2020 and 2021 was no less controversial because that time the ESG fervor was so strong, right? And as you know, that's such a huge ideological group of thinkers, particularly in the ESG index funds, which in my opinion is, and somebody saying what happens if they take out the index, I like music to my ears because we have to make money on somebody's rationality. In fact, I was saying if I had to follow an index all my life, I'll be bum on the street.
How does your principal, for example, like someone like a Norges Bank, feel about Adani? Recently, they made a big hue and cry over Adani's governance standards, his exposure to coal. Now, Norges is a big investor in your fund.
They're not invested in a fund. They are a shareholder. Yeah, we haven't had any conversation with them directly, but I think everybody knows we invest in fossil. We own coal companies too, by the way. So it's public knowledge. I mean, so we have said that's our job is to invest within the constraints given to us by our clients.
Right.
And then maximize the returns. Look, at the end of the day, this business, in my opinion, is about performance. Rest is talk and talk is cheap.
True.
It's performance that matters.
Absolutely. But you don't worry about money leaving your fund because on Friday, I saw your stock down 3% as well when the news became public.
As somebody has said, what do stocks do? They fluctuate. In fact, if you look at our performance last year, if you ask me strategically, we are very well positioned today because of, I said, thanks to the ESG folks. I mean, they want oil and give us bargains at 20% dividend yield and free cash yield. Fantastic companies. Look, hallelujah. Well, we're happy to own those. Will the stock fluctuate? Of course, it'll fluctuate. But again, you got to take a long-term view and on a 5-year basis, if we can deliver performance. See, the key issue is performance.
Yeah.
If we invest in performance, everything is fine. If you don't deliver performance, nothing is fine.
Absolutely. No, because historically, you have been buying into dividend-giving, steady cash flow-driven companies vis-a-vis India. Tobacco companies like ITC, HDFC, Bharti, you like them. But Adani Group companies are guzzlers. They're cash guzzlers. They spew capital. That's a different strategy altogether, no?
No, not necessarily. There's a disconnect. In fact, I disagree with your characterization. They're guzzlers. They are not, because they are expanding for growth. If they stop it, because think about the airport. What is the capex for airport without growth capex? These are not very capex heavy businesses. But if you're expanding into Navi Mumbai for the new airport, that's a different thing. But that ultimately means more passengers, right? So we have invested plenty of technology companies where there was no dividend, but they were purely growth. In fact, NVIDIA was a big position for us for years when they never paid dividend, and they were massive growth companies. You got to look at everything with a different lens. What's the common theme? The common thread is, can we compound our and our clients' capital on a double-digit basis? That's the objective. Doesn't mean we'll deliver that in dollar terms, right? We hope to deliver that. So that's the lens. Sometimes you buy cheap because their dividend itself makes sense. Sometimes you buy growth and everything in between.
Everything is attractive at a price. And naturally, I want to know, has the prices indeed bottomed out? On the face of it, perhaps, as group companies have recouped about 18 billion in just last 1 week. Let's talk about the price, because you said that, price plays a key role and everything comes at a price. The prices of Adani Group companies on average are down 60 to 70%, in some cases a little bit more. Yet, none of the anchor investors from the FPO are looking or have looked to catch the falling knife with you. Wouldn't you have been more comfortable if they were also coming in as co-investors?
Not at all. No, but because why would that make any difference?
From a confidence point of view?
So sometimes sometimes you're good company, sometimes you have no company. That's perfectly fine. I mean, look, we have to do our own due diligence. In fact, we have owned a lot of companies over I'm talking over decades or 2 decades. I mean, I'll give you another example. I mean, early 2000s, 2001 or thereabouts, we went from almost 0 to 30% over a 2-year period in South Korea.
Right.
There are a lot of companies that had no English annual report. I had to get them translated.
Wow.
And in fact, I remember meeting a company. They said, you're the first investor we're meeting in 6 years. And the reason was because he said, you own the stock longer than I have. The CFO said that. It was a confectionery company, by the way. I said, look, it's an easy business. Even I understand candy confectionery business.
Don't tell me it was a lotto.
It actually was that. So a lot of this is what is the cash flow that they generate and how would the free cash to develop over the next 5. That's why we call the forward-looking quality.
No, why I'm asking you this is because, Indian fund managers have also stayed away from the Adani story so far, in the FPO or even otherwise. So therefore, a lot of people are actually in India calling you a one-person national team.
Do you know how many people covered Berkshire Hathaway for the longest time? How about one? And that was only 10 years ago, or 40 plus years. There was no sell-side coverage on Berkshire Hathaway. Most of the institutional investors didn't own Berkshire Hathaway, by the way. So
are you comparing them? Are you comparing Gautam Adani with Warren Buffett?
No, I'm not comparing, but I'm saying that there's plenty of history. But I think this is that. I mean, look, there are 100 ways to heaven. You just need to find one.
True. I agree. But, you talked about the companies and the cash flow. Here, the issue is that it is actually a secondary. Your money has actually gone into the SB Adani Trust as cash. Probably the street would have preferred if they had gone directly into the companies to improve their their leverage ratios, etc. Did you explore any other structure so that the companies themselves could have been the direct beneficiaries?
I think the current problems are not at the company level. Is the pledging that was a concern.
Right.
And this actually reduces that risk. So we fundamentally disagree that companies have a cash flow problem. We don't believe they have a cash flow problem. Are they a little more levered versus, let's say, IT services? And yes, I agree. But these are fundamentally different animals. They have 20, 25-year visibility. I think that was at the promoter level, that was maybe a little more tightness, arguably, or the perception of that, rather than the company level. I mean, Adani ports, they don't need cash at all. I mean, why do they need cash?
Correct. If you see a lot of the credit rating reports, their principal point has always been, if I can drill it down to only one point, is that the equity cushion in most of these companies is limited. And that is a risk, according to them, in varying degrees. So that's the reason why.
Look, I'm not disagreeing with that. All I'm saying is that the free cash flow will look meaningfully better if they slow down capex. Because these businesses are not inherently very they're in capital intensive, but are on the maintenance capex on a lower side.
Won't your investment be going to primarily towards paying the interest commitment of the promoters or to pay down the ACC Ambuja debt rather than grow the companies going forward?
Arijit, the issue is, what is the underlying growth rate of the business with more capital and without more capital?
Yeah.
If you think about the ownership of the group, why is it that high? Why is it that the Adanis own 65 to 75% of these businesses and they build this empire? Let me give you an example. When Microsoft was listed, Bill Gates owned around 50% thereabouts of the company. Most of the tech companies, when they list, the ownership of founders or promoters, whatever they call them, tend to be low. Why? Because there's not enough cash generation. So the reason why Adani's have such large stake is not because of anything else, except that there's inherent cash flow generation is strong. Look at the retained earnings in the book. Retained earnings are fairly high, right? Where do the retained earnings come from? They're actually not issuing equity that much. They're pretty stingy about issuing equity, which we like. So the underlying cash generation is actually stronger, but they also invest in capex, which means the free cash flow is kind of negative, right? It's just increasing the underlying cash generation sort of capabilities of these firms over the long run.
Coming up in the show, is there some funky structures behind the headlines? How long is Rajiv looking to hold on to his investments? And what are his return expectations from Adani Group companies? So let me get the record straight. This is not a guaranteed IRR kind of a trade.
The guarantee IRR is, in my book, it doesn't exist. Not here, not anywhere else for that matter, by the way.
Okay.
Look at Microsoft. It was growing at 20% sort of, revenue.
Right.
Summer of last year too. I mean, I remember Satya came out, everything is fine. This is last May, right? Everything is fine, blah, blah, blah. What was their revenue growth at last quarter? Around 6%. 6.
Yeah.
Nobody knew. Satya didn't know, otherwise he wouldn't be pounding the table in May last year.
When we've seen prices falling so much, founders usually double down. But here we see they're selling equity. Ideally, shouldn't they have been putting money into the businesses to show their commitment to their own story?
There are a lot of things you can say, ideally this or that should have happened. But I'm not here to analyze what they could have and should have. The question is, these are the cards you have been dealt. Now you play the game. And that's my view. We could have, should have 50 things. Yes, but we can't spend time pontificating of what could have, should have happened. But these are the cards. Question is, what do you do now?
Right.
And the fact is, they have pretty high insider ownership even now. So the other part is that 65, 75. I mean, how many promoters, by the way, do you know that have that kind of ownership in India? Not many.
Fair point. So what's the investment time frame or horizon for you? How long will you wait for things to turn?
First of all, things are not really bad anyway from a business perspective. There's a balance sheet issue that we're discussing here. The underlying cash flows seem to be fine. Right? So if the capex slows down, the picture will emerge better than what people think. That's our bet. It could be wrong, but that's our bet. In fact, I think a lot of the issues are kind of solved in my opinion. They reduced the pledge a little bit and there's no refinance issue with 18 months. Look, 18 months is a long time in markets, as you know. People, I mean, I said, I don't think the most would remember that there was a whistleblower case against Infosys and the stock was down 25-30%. This 3 years ago.
Yeah.
People forget.
So are you looking at a 10-year, 8-year, or maybe even longer kind of a horizon? What's typically been your strategy when you come in? Because as you said, you've been an investor in ITC for over 2 decades.
Our view is that we take at least a 5-year view in anything we do. But then we have to adjust speed based on the conditions.
Right.
So we're taking 5+ year view and hopefully we can own this for a long time. So this is not a 2-year trade at all. In fact, I would say this is really a 10+ year trade because the headroom is dramatic.
Right.
Most of the private sector is done. I mean, how many private sector folks do you know are in these kind of utility type businesses operating successfully? You can count in left hand.
True.
It's just basically the state-owned companies.
Yeah.
Or few players.
What kind of return expectations do you have?
Well, they're all sort of in mid-teen kind of levels. And we feel that's where the entry price mattered. I mean, and I think that's very doable without having any sort of crazy debt or increasing debt and so on and so forth.
You talked about that, how many in the private sector do you see who are doing what Mr. Adani is doing? Is that what actually drew you to the Adani story? How would you describe Gautam Adani as the entrepreneur and his phenomenal rise in recent years? Would you attribute it to his business chutzpah, his vision, guts, or a bit of political patronage as well?
I mean, I'm going to answer it differently by not answering this question. Okay. You may or may not remember this, but the 80s, how long was the wait list for getting a scooter in India? It was 7-8 years. That's what I remember, early 80s. Yeah. How long it took to get a phone? How long? There were 2 cars only, by the way, right? Was it because nobody else wanted to sell car here, or because the markets were artificially restricted for others to come in? Right?
True.
So I think what you shouldn't lose are the fact that things were not handed on a platter. The ports were not handed on a platter. It's kind of a desert area, which wasn't really even connected to anything. And this is considered one of the most efficient ports in the world.
True.
SoftBank Energy, they couldn't run their solar farms, and they sold for a song to these guys. And so far seem to be running fine.
Yeah.
I'm not denying political connections, to be clear. But you can say that of a lot of large houses here.
But did you know Gautam Adani or his brother Vinod Adani from before this trade?
I've never personally met him, by the way. But
even now?
I've never physically met him.
Oh, so even during this trade, that was finally what?
I talked to him. I talked to him now, but I'm saying I've never physically met him. That's what I'm saying. So if you think about it pre-COVID, so I mean, some of the analysts I met, some of the management folks in New York last summer when they were on a road show. We've owned companies where I have not met the management. That is not unusual. A lot of times, that's my personal experience now. It's an observation, so not a sort of how the world operates. Is that I've seen I don't have that good an ability to understand and read everybody. So you can easily be delusional, say, oh, you understand, this is going to be great management, right? So I feel that it's important for management folks to meet management, but it's not necessary for me to meet management all the time. So we tend to be much more numbers oriented, and then we build the qualitative picture around it.
For a man who has played in Putin's backyard or seen Xi Jinping's China up close, I wanted to get his emerging markets lens out and also understand, does he see Gautam Adani as a proxy to Prime Minister Modi's economic vision? Let me ask, this elephant in the room. Are you doing this to compensate perhaps the fact that you were overexposed Russia last year and not so exposed to China reopening now as you perhaps would have liked to be?
No, there's nothing to do with Russia or China, by the way. So look, I mean, we tend to be very bottom-up investors. And we're very concerned about the earnings trajectory in China.
Yeah.
Which is why we're not finding a lot of names, right? We are not index huggers, although everybody says that. You look at the portfolio, say 100 or 200 basis points over underweight China and 100, 200 basis points over India, right? So okay, that's index hugging. So we feel that the opportunity set, by the way, Russia was the same thing. We were very bullish on Russia, and we turned out to be dead wrong because of an event. In fact, we wrote a piece of paper in 2017 how things had changed in Russia for the better. It was early 2017. And if you look at the return, the markets actually did very well for next 5 years. It was the best, one of the best markets in emerging markets. So my fundamental view, by the way, is that most of the folks don't appreciate change. They anchor on the past too much. And if I look at today, the setup, would we have bought Adani position if, let's say, by the way, I mean, for all the discussion, it's not like we're putting a 20% bet on the fund. It's a low single digit sort of exposure. China, the geopolitical risk has gone up quite significantly. I still believe people are underappreciating. I mean, think about it this way: Jack Ma was asked to hand over Ant to the government.
Yeah, true.
I mean, why is that exciting? I was blown away. Baba was up that day. It's like, hang on, the government basically taken over a private asset, and people are jumping with excitement. That makes no sense.
Exactly.
There are also pendulum swings. I've invested in China for a long time. The pendulum swings. So we try not to be dogmatic about these things.
Mm-hmm.
And it's case specific, and things move and they create opportunities.
True. You pride yourself to be a quality growth investor.
Yes.
Growth, yes, I can understand. Adani is dripping with growth. Quality at this time, because are you not concerned about the governance standards? Or is it a bet that the standards will actually improve from now on? Or there's a cynical view as well that the Indian fact-finding will never really catch up?
So when we talk about quality, let me ask you this. Can you replace Mumbai Airport? Can you replace the T&D monopoly that they have in Mumbai? By the way, the reliability of that is 99.99%.
Mm-hmm.
Right? That's pretty damn good. I looked at the numbers of Florida Power and Light, a stock that we owned before in Florida. That's 99.98. And by the way, that matters a lot because you took Indian conditions on top of that, right?
Yeah.
I think every story has to have some disconnect. If it was perfect, we wouldn't be sitting here discussing this. I think that is what makes investing so much fun, in my opinion. I would broaden out the discussion beyond Adani, because if you look at the opportunity set in India, do you really want to buy Hindustan Unilever at 55, 60 times the earnings? Asian Paints, I mean, it's a phenomenal business.
Yeah.
We owned it for a very, very long time. But a lot is also in the price. So the differentiation is good company versus good stock, and so on and so forth. In this case, we believe it actually is a very good combination of both, because the assets that they have are not replaceable.
The reason why I'm asking this, the optics of it, the timing of it, that currently they are facing a tsunami of bad press or bad publicity, whatever you call it, on social media as well. Is association by proxy even impacting you?
Well, maybe I'm a little more thicker skinned. So when we bought Exxon, we became the largest non-index owner of Exxon, which I was blown away. And we are not a large player, by the way, right? There are plenty of shops run $1 trillion plus. There was a total disconnect, we thought. But Adobe was 50 times forward earnings, and people are jumping at excitement. So, I mean, if you look at the Zomatos and Nykas of this world, maybe some of them might turn out great businesses. But you have no idea what they're going to be in the next 12 months, let alone next 5 years.
Right. No, I understand that. But are you comfortable wading into the fact that this is now becoming a political hot potato till at least elections of 2024?
On the political side, there's always a lot of discussion about that. And I think the reality is, in my opinion, a lot less extreme.
Got it.
So these guys operate in a lot of states where there are different sort of parties
dispensation.
in power. I mean, I've heard that story on Reliance for 25 years about the political affiliation and so on and so forth. I mean, these come and go, but we can't run the portfolio based on what the politics is. I mean,
correct.
The problem, the markets are very, at the end of the day, it's about dollars and cents or rupees or whatever, right? Money talks. So if we can generate cash flow, because the growth, all of that can happen. But it's hard to take a 5-10 year view and say, oh, that will happen, this will happen.
Absolutely. But what are the business risks that you will be closely monitoring from now on?
Yeah, I don't want to name one or two for obvious reasons, but I don't believe there's
broadly
unique business risk. Look, I mean, for example, they would, in a regulated business, regulation is always a risk, right? Regulation could change for the worse. I think those kind of risks are there. Would need access to capital markets in the long run. I don't believe that's a problem, because these are fantastic assets. I mean, you saw the bond yields, right? I mean, they blew out initially, but they were not crazy valuation. It's not like, I mean, if you look at the Chinese property name, they were yielding 40-50% at one point in the crisis. I mean, I believe transmission is still under 10%, is 9%-ish or something. Green is, I think, 12-13%. I wouldn't be surprised by the way they come in pretty quickly. These things, and the rating agencies pretty much all have reaffirmed the ratings. But it's hard to predict what exactly would we be looking for also, because I couldn't have predicted it. Look, let me put it differently. If we owned the stock, let's say Jan 1, could we have predicted this risk?
Let's look at Adani Green. What if the French regulators force Total to exit? Won't it significantly increase the business risk then? Have you considered that?
Why would the French do it? Why would the French government intervene? The Total is a pretty happy owner, by the way. We talked to them. They're very happy. But just so you know, we own Total also. We are one of the largest shareholders of Total. We're probably top 5 shareholders of Total. And we talked to them and they're pretty happy. They put it on hold. And I understand why, because there's always pressure to wait and watch and so on and so forth. But look, they're not unhappy as such.
Okay.
And they do know if they leave, they won't be getting anything back in India for sure, because nobody else is doing it. If it happens, we'll cross the bridge when you get to the bridge.
Correct. Now, ports, again, they build something which is totally world-class in the middle of a desert. No point taken. But are you concerned that perhaps some of the global expansion of the ports are not really shareholder-driven decisions, but are strategic bidding for India's foreign policy?
Well, I think time will tell. But if you look at the Israel acquisition, we feel it actually strategically makes sense. I don't want to go into too much detail because I don't want to give ideas to everybody else too, by the way, right? This is competitive business. I don't want to give a whole case to you and then, because look, if the stock is here 6-9 months, what makes you believe you won't double down?
Right.
HDFC Bank we bought for years and years and years. We're not here to flip.
True.
So I would rather we buy it if there's more disconnect. Let's say stock is down 30% next 3 months. Look, I don't think I'll be unhappy because it gives us the opportunity to. These are not large positions yet, in a way.
True.
But we don't put everything in one shot. It's a big position in a sort of relatively speaking, but there's no reason why we can't double down. We have much larger positions in a concerted way.
Adani Enterprises, set of small businesses or like a conglomerate in itself, if they cannot divest or list some of the smaller businesses, roads, data centers, the minings and metals businesses, is that a business risk for you?
No, in fact, some of those may be better off remaining inside.
Okay.
You don't have to spin off everything because sometimes the markets may be too short term to give you a benefit.
Point taken.
You want to incubate longer and then do it because they're more mature.
So bottom line then is you are betting on the Modi story as well. The fact that India remains largely resilient despite the tsunami of bad news around this one particular conglomerate.
Well, look, I've invested in Korea for a long time, Taiwan and China and so on and so forth. So this is not that dissimilar from what we saw in some of those countries in certain phases of growth. If India can pull that off, I think you could be in similar sort of cycle, which maybe China was 25 years ago, right? So I think it's less, I would sort of zoom out a little bit, and maybe US was the 1950s, right? We saw the massive, construction boom in US post-World War. Europe for a different reason, Japan for a different reason, obviously, right? But US, there was a massive post-World War construction boom. There were different group of companies that made a lot of money there, right? So our view is that it's a sort of a probabilistic bet that we are heading in the direction which you're suggesting. It's not a given, but there's plenty of playbook historically in other countries they can watch and say, you know what, that might be the next play. And these things tend to last a long time. They're typically not 2-3 year cycles. They're longer cycles.
Rajiv Jain, it was an absolute pleasure talking to you. Thank you for taking your time out. Deeply appreciated. You have been listening to GQG Partners founder and chairman in this special podcast, Rajiv Jain's Adani Adventures on the Morning Brief. A big shout out to my producer Vinay Joshi, sound engineer Indranil Bhattacharya, executive producers Anupriya Nair, Anirban Chaudhary, and yours truly. We hope you liked this episode. Do share the episode on your social media networks. The Morning Brief drops every Tuesday, Thursdays, and Friday and is available on Spotify, Apple Podcasts, Amazon, and Google Podcasts, as well as JioSaavn. Do tune in to ED Play, our latest platform for all audio content, including the Morning Brief. Goodbye and good luck. All clips used in this episode belong to their respective owners. Credits mentioned in the description.